Hello everyone, and my name is Ryan Hughes. I'm Head of Active Portfolios here at AJ Bell, and we're delighted today to be talking to you about the perennial debate that goes on in the investment industry. That is it active or is it passive? And to go through that, I'm really pleased to be joined by my Head of Passive Portfolios colleague, Matt Brennan. And what we're going to do is split this into two, really. I'll take the first half and I'll try and make the case for active management. And then I'll hand over to Matt, and Matt will then make the case for passive management, and we'll kind of sum up at the end and hopefully draw some conclusions out of that. So without further ado, let's crack straight on. I've talked you through the agenda already, so we will launch straight in and just give you a little bit of a background about AJ Bell Investments. Acutely aware that many of you might be hearing from us for the first time, but also quite a few of you have been using us for your portfolios, and for that we are very, very grateful. So we've now gone through over 800 million in our range of investment solutions, which is fantastic growth for us over just the last couple of years. So thank you very much for your support. And that covers a range of passive funds and MPS, active MPS, active MPS, the beautiful marriage between active and passive, and that may be relevant for this webinar today. And of course, our retirement portfolio service as well. So let's launch straight into this. I'll take the first bit regarding active management, and I think as the image sums up, really, it is very much. It feels like that the debate on this is kind of a fork in the road. You either are an active manager or you're a passive manager. You either favour active management or you favour passive management. Now, I've been doing this job for 20 years in various different guises, researching managers, and it feels like it is an either-or discussion. And I think what we'll try and explore today is whether that's a sensible approach. But the kind of nuanced debate that there is one of you're either an active manager or a passive manager, and not much in the middle, which seems like an interesting debate to me. So let's just start with the basics, so that, and I'll go through both active and passive to save the switching between presenters, given we're doing this remotely, as you can imagine, these days. So active or passive? Well, let's look at what passive is as a kind of introduction to passive. Designed to track the performance of a simple index. I think that's nice and straightforward, and we can all get exactly what passive managers are trying to achieve. No real element of human choice involved in the holdings. It's rules-based. I know Matt, when he talks lots about rules-based investing rather than passive investing. And personally, I think that's a much better way of articulating what passive management is about. Now, of course, we know that investors go where the market goes. They follow the market. Market goes up, their investment goes up. Market goes down, their investment goes down. Of course, we know in the last few years that it's been going up significantly. And that's been great for anyone invested in passive management to be able to ride that wave, which is what passive really has enabled you to do. And of course, the key thing about passive investing there is its low-cost market exposure. I'm sure Matt will talk about costs and where they've gone, but clearly, when I look at the market, costs for passive investing or costs for simply gaining beta have fallen over the last few years. There's been a lot of price war, a lot of competition. And gaining market exposure has become cheaper and cheaper, which is fantastic for investors. We shouldn't knock that. That's been a great outcome for investors. If we flip to the other side of the chart there, active management. What is active management? Well, the fund manager follows a strategy that they have selected to choose their investments. And that could be all kinds of different strategies: growth, value, large cap, small cap, blended, global, regional, short duration, long duration. Every different kind of investment strategy you can imagine. There is an active manager out there pursuing that strategy, and of course they're aiming to outperform a specific benchmark or deliver a certain outcome, a specific outcome. Now, mainly they will be focused on delivering outperformance of benchmarks, but certainly the more kind of solutions-driven world that we've entered now is more outcome-driven investments too. Portfolio will often be positioned quite differently to an index. Now, some will run quite tight to an index, others will have much more flexibility, so very different to a passive. Now, of course, there is the risk of underperformance, but there is the potential for outperformance there. So if you want to outperform, you have to look different to the index. And of course, in doing so, you will risk that underperformance. And of course, we know that active management costs more than passive, and indeed quite often costs a lot more than passive. So that's something we need to think about. Now, there is an overlapping part of this diagram here, which is smart beta, which falls somewhere in between. We're not going to focus on that today in this session. That's probably worthy of a separate session in its own right, but it's an area that's growing quite rapidly. So let's make the case for active. This is looking at some research from Morningstar, and it runs to the end of 2019 to keep it nice and easy for looking at the numbers. And of course, it focuses mainly on the US, as there's a wealth of data there. And actually, we see quite an interesting picture in 2019. Now, granted, it's a short time period, but what we can see in here is that in certain areas, I think we can make a pretty strong case for active management. In other areas, we can make a weaker case for active management. If we start right at the top, US large cap, I think we all know and agree that it's very difficult for active managers to outperform in a highly efficient market like the US large cap part of the market is. And so we can see in 2019 that really around a third of active managers outperform, a pretty poor hit rate. If we go down a little bit further, we look at US mid-cap growth. Well, there in 2019, 72% of managers outperformed, much better hit rate. And again, in small cap growth, we go even further down, nearly 75% of managers outperform. So I think what we can see here is there's pockets of opportunity, there is pockets of excellence, but I think, yeah, myself as someone with a job title, head of active portfolios, as Matt knows, yeah, I am the first to say that probably 80% of active managers are not very good at what they do. And it is a small pocket of managers we think that have got genuine evidence of skill. And we need to look very carefully for that and select our active managers in the right places, accepting that in certain places, perhaps active management isn't a fantastic place to be, as these statistics bear out. And I think that's essentially really what we try and do in our research process, is separate the skillful from the lucky. It's very, very easy to be lucky over short periods of time. It is much, much harder to be lucky consistently over a long period of time. There are very few managers that can deliver long-term outperformance. There are lots of managers that can deliver short-term outperformance. And what we're trying to do is separate those managers that simply have had some luck. They might have just been in the right place at the right time. Maybe they've got one or two stocks that have driven their performance, versus those managers that can deliver more consistent, more long-term outperformance, notwithstanding that styles change, styles come and go, and that different managers, actually, if they do follow a very particular style, will have their fortunes will differ as the market changes. But long-term is really where we think there is some evidence of skill for some managers. Now, if we boil that down, what do I think the secret of that is over time? Well, I think it comes down to process, and more process. And that's all about, I think, over the long run, if you have got a good process that is repeatable, then you improve your chances of having a good outcome over time. And this diagram is from a piece of research from Russo and Schumacher in 2001 called Winning Decisions. And I think it's a really good visual way of thinking about the different successes and failures in active fund management. Every now and again, there'll be a manager that has a good process that doesn't have a good outcome. And that happens in the market. You know, a very high quality value manager right now is underperforming. It doesn't mean they're a bad manager. It doesn't mean they have a bad process, but value is just out of favor. I think it's equally possible to have a very bad process and get a good outcome over short periods of time, as we saw on the previous slide. That short-term luck that comes into play. But over long periods of time, I think it's far more likely that if you've got a bad process, you're likely to get a bad outcome. And ultimately, that's really, as it says here on the slide, poetic justice, that's exactly, sadly, what you deserve there. So it's about separating skill from luck. It's about looking at a manager's process, understanding that process, and seeing how repeatable it is over time, and making sure you're measuring it over sensible periods of time. So what I wanted to do here was just look at the different outcomes that you can get from active management, looking at a wide variety of sectors. Now, I keep this slide up to date. Some of you may have seen me present it before. When I was updating it for this presentation, I ran the numbers to the end of September. And what I noticed when I did this was that the gap between the best manager and the worst manager in this over this 5-year period to the end of September has widened dramatically since I last updated it, which would have been about 6 or 7 months ago. So the dispersion of good performers versus bad performers has got wider. And what it means is you do need to select very, very carefully for your active managers. I mean, if we look at the UK all companies, the best manager up over 100% in 5 years, the worst manager down nearly 30. Now, of course, that, again, it comes back to maybe that manager who's down 30, maybe not a bad manager. It may be about the style, the type of investment that they make, and so on. And it's for us to understand that. But they may be a bad manager. They may have a bad process. They may get the outcome they deserve. And so fund selection has to be very carefully done. And as I say, with my view that around 80% of managers are not great managers, then picking carefully through that and navigating through that becomes ever more important. Even when you go to the far right of this slide and look at strategic bonds, well, even in bonds where we would always think about lower returns than equities, well, the gap is pretty wide too. So getting your bond manager right, have they got lots of high yield, or have they got lots of government bonds? Is that a permanent tilt, or are they flexible? These questions become really, really important because it will drive the type of outcome that you get. And this leads me to coming on to how do we think about different active managers? And I think this is a really useful way of looking at it. This is from a great piece of work that actually is from the people that came up with the concept of active share. Now, if you've met any active fund managers over the last couple of years, you've probably heard some of them talking about active share. And that essentially is how different is the fund composition to the benchmark. Now, let's take an example. If Shell is 5% of the FTSE All Share, if they've got 6% in Shell, they've got 1% active. If they've only got 4% in Shell, they've also got 1% active. So you're adding up all of these differences to try and get a view as to how active your portfolio is. How much does it differ from the benchmark? Now, different active funds actually attack this problem quite differently. So if we start in the bottom left-hand corner, right in the bottom left-hand corner, you've got low tracking error, low active share. Well, at the lowest sense, that is an index fund. That's a passive fund. But actually, there are quite a lot of funds that have got a low tracking error and a relatively low active share that are actually just closet index funds. They're simply not, they're just not taking enough risk against the benchmark. And in many cases, you'd be better off just investing in a passive because you're paying active fees and not necessarily getting active management. So there, I don't like those type of funds. Personally, I would much prefer, if I wanted that type of exposure, to simply keep my costs low and go for a pure index. But it is possible to get low tracking error and high active share and have a much more diversified portfolio there. And that I think is a very valid approach. And if we move to the top right, then we've got high tracking error, high active share. We're thinking about concentrated funds. We're thinking about really high conviction stock picking here, not looking like the benchmark at all, giving yourself the best chance of having a different outcome to the benchmark. Now, I deliberately didn't say the best chance of outperforming, because all you know when you invest differently to the benchmark is you should get a different outcome. Could be good, could be bad. So we need to look at that very carefully to make sure we pick where we think the best managers are based to do that type of concentrated stock picks. And then we get into the realms of the bottom right hand corner of factor investing. So that is high tracking error, but low active share. Again, think about a value manager, think about a growth manager. They're taking quite different views to the market in terms of style, but maybe actually having a relatively low active share. So this piece of research I think is really interesting, but I take it a little bit further because I start thinking about then what is the right price to pay for managers that follow these different strategies. And my personal view here is that there needs to be more price differentiation in active management, so that actually I'm relatively comfortable paying a higher fee for someone that is genuinely active, but I think active managers that are not truly active should be charging a lower fee. And if we look at that in this sense, so it's a slightly busy slide, but what I've done here is I've taken the UK all company sector, and I've plotted OCF along the bottom, and I've plotted alpha up the side there. And in theory, of course, what you should see, if you believe in the concept of what you pay is what you get, we would imagine that if we pay more for a fund, we get better outperformance. What we see here is there's absolutely no correlation there at all. And actually, funds cluster around the 75 to 90 basis points. You can see that strip down the middle. There is a clustering of cost, and there is a very wide dispersion of outcome. So there is no correlation between what you pay is what you get, but as ever, there are pockets of excellence. If you look on the, if you look right at the top of the chart, the highest dot there is, well, average fees there in line with the sector and have delivered some pretty strong outperformance. If you look at the dot that's highest to the top left-hand side, well, you've paid lower than average fees and you've got a pretty good set of performance, not a bad outcome. If you go right to the right-hand side, you've paid incredibly high fees, an OCF of over 2%, and you've only got a tiny bit of outperformance. So these things really, really matter. I think this is a useful visual if you're doing sector-based research for just looking at how the sector is dispersed on cost versus performance. And that leads me on to the assessment of value. So this is a new document that's come in this year, and I've just grabbed a few headlines here from different publications, which is really, I think, showing that assessment of value, I think, has been a good introduction from the FCA. So it was an output of the asset management survey a couple of years ago, where they wanted active managers or asset managers to in writing show to customers, are their funds delivering value for money? And what we're seeing is fund groups are having to do this, and it's causing some interesting discussions. And we can see from the headlines here, Schroders cuts fees and scrutinises its multi-manager range in its value assessment. Great. Artemis shakes up its fund range after a review. Great. Aberdeen Standard Investment singles out a trio of funds for underperformance in its value assessment. Yeah, there has been a whole wealth of these headlines over the last 6 or 7 months, and this is only in year one. What we're actually seeing right now is that most managers are saying, yeah, the fund is underperforming a little bit, but it's roughly in line with our expectations. That's going to be much harder next year when they have to do their assessment of value again. And if it's still underperforming in the third year, well, I think things start to give. We either have to have fee cuts, or we have to, maybe the fund gets closed or merged, or maybe there'll be other changes to the strategy, but something will have to give. So assessment of value, I think, is starting to keep active managers honest, and that can absolutely, honest in the way that they talk about their performance and how they charge for their funds, and that absolutely is a good thing. So I'm just going to sum up my active management, my case for active management. You might think I was quite negative on active management there. I think I'm much more of a realist when it comes to active management, not least when you see my first point on my summary. Too many active funds are letting down investors. I don't think we can get away from that fact. But we shouldn't throw the baby out with the bathwater. There are very, very high quality fund managers, active managers, who have the ability to outperform. We've seen that in recent years. We've seen some fantastic performance from, probably wrong of me to name specific managers, but in general, you will know the types of managers I'm talking about there, who maybe followed a quality style or a growth style, or have invested in unquoted stocks. In certain cases, they have been fantastic outcomes. Now, clearly for other managers, they have been a disaster. So we can't tar all managers with the same brush. Also, let's accept that all active managers won't outperform. Active managers won't outperform all of the time. No one manager has the ability to outperform in every market condition. A growth market, a value market, a quality market, a market that favours large caps, a market that favours small caps. Nobody runs a fund that can deliver in all of those markets. So it's about us understanding what type of market they can deliver in. Becomes absolutely crucial to what we do. Investor apathy does remain a big, big problem. There are lots and lots of small funds out there not delivering for investors, and the reality is, if the investors sold, then those funds would have to be shut down because they'd be unviable. So I would urge people to be more active about their active managers and make sure they're delivering for them. And assessment of value is a crucial first step, I think, in this journey, and is starting to make a difference. But we're much more interested in what it does in year 2 and year 3. So we watch that with interest. So that's my case for active. I've raced through quite quickly, so apologies for that, but we've got a lot to squeeze in. I'm just going to hand over to Matt now, so just bear with me on the technological side as I do my best to make Matt a presenter, and we'll see how this handover goes. Are you sure you want to make Matt Brennan a presenter? Well, on the basis he's about to make the case for passive and I'm an active guy, probably not, but let's do it anyway.
So before I make the case for passive, really want to just take a step back and talk about actually what's important when building a portfolio, because we talk about active versus passive, but actually that's a very small part of building a portfolio, where asset allocation is really more important when it comes to this. So Ryan previously had a few news headlines, and I think the important thing is, you know, the FT is trying to sell newspapers, and it's very unlikely they're going to run with the main headline, ETF tracks index. It really doesn't sell newspapers. Equally, Ryan's phone is off the hook when a manager is fired, when there's changes, when stocks underperform or outperform, because that is really the exciting part of the stock markets. But important. So let me try an analogy. Apologies if I stretch it a little bit far. So, you know, people are very passionate about their cars, and what's important about a car? It's the engine, it's what's inside, it's the torque, it's the horsepower, and people are willing to pay money for this. So, you know, kind of people will spend multiples of their monthly salary on buying the right car, because they know that, you know, getting that part right is what's going to drive the performance of the car. On the other hand, people are willing to drive around and try and save a penny, 2 penny a litre on the petrol they put into the car. I really want to sort of use this analogy for building a multi-asset portfolio. Getting the engine right, so getting the structure of that portfolio right, looking at where you invest, which markets you invest in, how you structure your fees, is much more important than the underlying building blocks. The implementation is really commoditized, a bit like the petrol you put in. Again, just to stretch it even further, in some cars, the petrol is important. You know, if you drive a supercar, you're going to want to put in high octane fuel. So much like Ryan said, in some markets, the petrol is really important, but for lots of areas, actually, it's just a question of costs. Keeping that as low cost as possible, making sure that car continues to run, and allowing you to focus on making sure you buy the right engine, that your clutch is looked after, that your exhaust is good. So apologies for that. Hopefully it wasn't too cringy. But here it is in numbers. So a study from Vanguard, which is really based on longer term studies by Ibsen, Kaplan, etc. When you look at what drives the overall return of a portfolio, actually almost 90% of that comes from the assets you're in. So if you're in the US or Europe or UK, it's going to make a bigger difference if you've ended up buying if you bought Apple or Amazon. And yes, as Ryan showed, there is that vast array of performance difference between the best performing fund and the worst performing fund, but being able to pick the best performing fund in all regions, in all times, is almost impossible. And it's likely that you'll have some winners and you'll have some losers. So in that case, as I say, getting that asset allocation right is really important, and passive investment allows you to focus on that area because, as you say, you know you're going to track those indexes effectively. So to give you an example from 2020, the year to date, sort of through to the end of September, the NASDAQ index, so a measure of largely sort of US growth stocks, is up around 40%, whereas the UK, the FTSE 100, is down about 20%. So allocating to the right area of the market there, would have had a 60% performance differential. So getting that part of the portfolio right is perhaps more important than picking one active manager over the other, or going passive or active. So as I say, we appreciate the headlines are around that selection part, but it is as important to get the asset allocation right. Earlier, Ryan presented some shorter term sort of numbers on active versus passive. Here we have from the same data source, so from Morningstar, but slightly updated, so that this was through to the end of June. We look at the longer term track records of active managers versus passive managers. And what we can see here is a mixed hit rate. So there's certainly certain parts of the market where active managers have consistently delivered a really good outcome. So here we see, if we look at UK smaller companies, UK mid-cap, that actually around 2/3 of managers have actually managed to outperform the benchmark. Whereas if we look in areas such as US large cap or global equities, it's actually less than 10% of managers that have had funds for that full period that have managed to outperform the market. So again, I like to give a laboured analogy here. If you imagine the 100 meters sprint at the final at the Olympics, if you were allowed some athletes to start 20 meters further forward, they're much more likely to win. I mean, don't get me wrong, you'll occasionally get a Usain Bolt who's able to close that distance, but in general, it's a head start. And if you think of passive investing and costs, that is the equivalent of that head start over the longer term. So I think it was really interesting, the points Ryan made about costs. And I think that's what passive investing is doing to active management. It is making people realize that they've got to offer value for money. So it's not about passive and active, it's really about high cost and low cost investing. And if you've got a low cost investment strategy, then you're much more likely to outperform over the longer term, because you're going to have that amount of outperformance as a starting point every single year. The other element is humans. So I guess the wisdom has been that having a manager managing your portfolios is a good thing. The idea being that, during issues like the coronavirus, like Brexit, like the global financial crisis, having a captain at the wheel is going to add value. And I think the really good active managers are able to do this well. They're able to take their emotions out of this and take an objective approach to portfolio management, understanding which positions are oversold, which ones are overbought. But again, in general, actually looking at those short-term track records of many active managers, especially in times of crisis, they actually often do the wrong thing. They fall into what's known as behavioral traps. So, for example, loss aversion. They will sell their losers before they fall even further. That is often the wrong thing to do. However, when you take a rules-based approach to investing, actually you take the emotions out of investing, and actually it stops you sometimes selling positions at the wrong time. Now, we all know that obviously passive isn't perfect, and the way those portfolios are constructed does cause biases in the portfolio. But the point here is humans can add, but humans can also detract. So actually having that rules-based approach and knowing how that portfolio is going to react and work in times of crisis is probably a really important thing for an investor. And I think this is an example. So I don't think I've come across anyone who holds or who held the Woodford funds, but clearly some people did, as a multi-billion-pound fund. But here shows some of the biases and some of the things that happen under the hood of an active fund, and why you may want to stick with passive instead. So when you look at analysing a passive fund, it is really important to understand what's in that portfolio, how it's constructed, the liquidity of the portfolio. But the good thing is, once you've done that analysis, the actual way a passive portfolio changes, although it does change, companies come in and out of that index, but it tends to be fairly slow, fairly benign, and a few stocks will come in and out every year. Whereas in an active fund, as well as understanding that point of time analysis, that portfolio will change over time. So for example, here we have the Woodford portfolio before the issues back in June 2018, and then we've got Outer Ring, which is the portfolio after it's already seen significant redemptions. So what you can see here is that as the fund saw redemptions, the manager sold his most liquid positions. So the ones, to raise that money, he sold the most liquid positions first. And what was left was the less liquid positions. So what this means is two elements here. Obviously, the behavioral side of the manager wanting to make sure that he doesn't sell his illiquid positions at a loss. That's the first element. But the second element is that changing lens of active management. The fund might have been perfectly valid when you invested, but unless you continue to do that ongoing due diligence, what you've invested in may change, it may drift, it may change style, it may change liquidity. So if you are going to use active management, you really need to have that expertise, that team staying on top of things. Whereas actually passive can sometimes be a bit of a shortcut. It still requires due diligence, but because of those rules that are in place, you roughly know how that portfolio is going to be constructed at any point in time. Much like all active management not being good, I think it's equally as important to say not all passive investing is good. I think I've already kind of implicitly said, but for example, in UK small cap, I think it's very clear that active management is probably the way forward in that market. And we can see here, for example, the trading costs in passive. So people think of passive as being this I guess golden bullet when it comes to liquidity. And in the short term, actually, quite often passive vehicles will trade, or you will be able to enter and exit them at really tight spreads. So it's going to have very low dealing costs. But what's important to say on passive investment and in times like the COVID drawdown is they're only as liquid as the underlying holdings. So here we've done a drill down into different types of asset classes, and you can see at the top, the FTSE 100 trackers, because the underlying instruments have dealing spreads of 0.04% on average. Actually, you're going to be able to trade that, you're going to be able to buy and sell with no problems. Whereas actually, if we keep going down that, and as you see, naturally that those less liquid asset classes, in a typical market, you can actually buy and sell a FTSE small cap ETF for a spread of around 0.3%. But what we saw during coronavirus is actually that those spreads massively widened, and they widened to where the underlying equities were trading, which was typically around 1.5%, but actually during coronavirus was up at the 3 or 4% level. So what we're trying to say here is, if you're wanting to use passive for liquidity purposes, that's fine if you're looking at liquid parts of the equity market, but be warned, during different periods of time, that might not give you the liquidity you thought it would. So perhaps, yes, you don't need to do the same level of due diligence on the holdings and how they change, but it is really important that you look at the liquidity of passive investment you are buying. An interesting question that comes up is, and especially driven by the US, where you see headlines like over half of the fund management in the US is now passive. So I guess the question is that comes up is, how much passive is too much passive? Are we going to get to the point where actually, if everything is just taking this kind of rules-based strategy and everyone is just buying companies due to the size, due to the market capitalization, are we going to leave the markets unchecked? And I think, I think it's a very valid argument. I think you'd argue at some point, if it gets more and more passive, then the chance actually to make alpha becomes larger and larger. So the successful managers can actually make more money, and that will create that kind of seesaw effect where you'll end up with a natural equilibrium of active and passive. I think what Ryan touched on at the beginning, the idea of not passive but rules based, and also touching on this idea of smart beta. I think what we're seeing is passive strategies are changing. So again, just obviously a little bit of a joke here, but when you think of search engines back in the 1990s, when you typed in what you wanted to search for, it returned precisely what you asked for. The rules were very simple, almost dumb. There was no kind of algorithms that could correct for those sort of things. Whereas if we look at search engines now, when you search something in there, the rule set is much more complex. It's able to understand if you made typos. It can present related searches, etc., etc. And that is really where passive is going. So, for example, this year, we've seen really strong growth in what's known as ESG ETFs. So ETFs that also take into account environmental, social, and governance factors. So what does this mean? This means these ETFs are no longer constructed just based on the size of the company. Instead, they're looking at different factors. So, for example, it's carbon output. How serious is it taking diversity within its within its organization, the board structure, its human rights record, its controversy score? So Volkswagen, for example, would have failed these sort of screens because of the way the board structure was set up at Volkswagen. So as Ryan touched on, it's a whole separate debate to look at smart beta. But what we're trying to say here is passive is evolving. Passive is getting more complex and is moving beyond this idea of just buying the largest companies. And this actually means that argument of passive versus active, index funds, ETFs versus active funds is changing. We no longer have to worry about just indiscriminately buying companies, and we can now see how that's evolving. And we think this is a really good step. It allows you to get this good hybrid between good parts of active management and the low costs associated with passive management. So much like Ryan, I'm going to provide a summary, and hopefully on balance, neither of us have been on too much of a product push. So I think the first point is, as you say, security selection, which is what the debate about active and passive, although it's an important part of portfolios, is not the main part of building a fund. Getting that asset allocation right is probably more important. The longer-term performance of passive has clearly seen the trend come into fashion. More and more money is being allocated to that part. We're seeing this idea of blended portfolios of, as you say, using both active and passive. So that has led to large inflows. So again, that may cause kinks along the way. So as we've said, it is really important that even on your passive selection, you're doing the analysis. Passive investment does require less human capital. So this is really what does lead to those lower costs. When you set a set of rules and allow portfolio to be built using technology, this allows less humans. So I think what we're now seeing is active managers are starting to embrace technology further, and this is what's allowing costs to be cut on that side as well. And then passive investment does come with different risks. Liquidity is one issue, and we did do a separate piece on bond ETFs, for example, and how they worked during COVID-19. And finally, as you say, analysing passive investment should be done in a similar way to active fund research. And by that, we don't mean you should be checking the exact same things as I've already touched on, but having a dedicated due diligence questionnaire with your ETF managers that you're using, understanding the liquidity, understanding what's under the hood is equally as important on both sides and can add value. So how do we do it at AJ Bell? So as we almost gave the conclusion at the start, you know, both our active portfolios and our active portfolios use passive vehicles within their portfolios. It's not passive versus active, it's passive and active. We think it's important that the different markets, we pick the best solution. And I think that's especially important that given the active portfolio doesn't just use active vehicles, we always have the choice of going passive. So if we don't think anyone can outperform after fees in a certain asset class, we will use a passive implement. Each investment decision is assessed on its own merit. So we're not tied into certain fund ranges, into certain types of asset. And I think what we want to do here is say, actually, you need to go beyond just this idea of active and passive, but also think about the type of vehicle you're using. And I think this is being very apt given the suspension in property funds. So, for example, you know, the way we do things at AJ Bell is we make the investment decision. We decide that we want to invest in technology stocks or we want to invest in the Japanese market. The next step is then, as I say, to understand an active versus passive approach in terms of historic track record, costs, expected returns, to understand which route we should be taking. But then equally important, once you've made that decision, is to understand the appropriate vehicle. If the active strategy is taking significant liquidity risk, like small caps, like unlisted, like property, actually the appropriate structure might very well be a closed-ended vehicle like an investment trust. On the other hand, for where they're also buying large liquid stocks, a fund is probably the most appropriate vehicle. Similar on the passive side, you know, once we've decided to go down passive, we then look at how the underlying market is structured, and we understand if actually just picking the lowest cost, getting a pure beta approach is the most appropriate, or if we want to look into areas where, you know, passive could be appropriate, but there are minefields, actually you may want to look down smart beta. So for example, one area of the portfolio where we do this is high yield, where we've moved away from a pure beta approach, and actually we're making sure that those high yield bonds aren't just weighted to the most indebted companies, but instead of focusing on quality characteristics of the underlying issuers. So in summary, it's an emotive subject, and myself and Ryan have many a debate on this. But we think it's important to understand both sides of the argument, and we've hopefully presented these as facts rather than opinions. Security selection is important. Make sure you get that asset allocation correct, and as say, using a DFM or a model portfolio can help you do that. And then both elements are needed. It's symbiotic. Active needs passive, and then passive certainly needs active to make sure that the market continues to function correctly. So just to finish, it's not active versus passive, it's active and passive. We'd like to thank you very much for listening today. I thank you on behalf of Ryan as well. Hope you found both parts insightful and interesting. If you do have any questions, feel free to send them in, and we'll come back with answers. So thanks again, and have a fantastic day.